That's Michael Burry in a nutshell. He has accurately predicted 10 of the exactly 0 blowups that we've seen over the past decade.
Welcome back to another episode of Off the Wall. Markets are always moving fast, and we're here to help you stay one step ahead. I'm Nate Tonsager, and as always, joined by Monument CEO and co-founder Dave Armstrong. Dave,
Hello,
as
everybody.
2025 comes to a close, how are we feeling?
What's funny, in the old days when you used to write checks, it would take you a month to stop writing the previous year and the check date. But now that I don't use checks anymore, I don't have that struggle. So the new year is less catastrophic to me mentally and to having to rewrite dates on my checks than it used to be. But yeah, I mean, 2026, I just feel like Monument's coming up on 18-year anniversary. It's just time just flies. Time just flies.
Yeah, I think I write 4 checks a year for our water bill. For whatever reason, the water company has not figured out digital payments. So yeah, I hear you. It's a much easier adjustment than it used to be.
Well, today we're here for another Ask Monument Anything mailbag episode, or as we like to call it. Well, it's an AMA, and we like to call it Ask Monument Anything. But today we're going to answer some more smart questions that we've gotten. And I'll tell you, Nate, what's been exciting is the questions have really started to roll in. Like we may have to take questions and roll them into the next episode. So
yeah, it is kind of amazing, I have to say. So we've had questions come in through email. We had a YouTube comment, which I think is going to kind of be a pseudo 4th question later that we'll get to. But we always like to remind people that we're recording this episode December 11th. Things change fast, as we said at the intro. But today, diving into 3 kind of topics or questions. And today's topics are Michael Burry and other market pundits' investment projections, Bitcoin, cryptocurrencies, what was their performance in 2025 or the story in 2025 around those? And then finally, it seems like private credit investments might be coming to 401k plans. So what used to be a illiquid kind of exclusive asset class seems to be getting opened up to the public. So we got those 3 topics. Dave, I'll let you pick, as always, pick your poison. Where would you like to start?
I think the question about Michael Burry is the most interesting. Let's go there.
Yeah. Right. And I think kind of just so everyone understands, we're using the name Michael Burry like everyone's going to know who he is. In the investment world, we do. But I think most people know him as Christian Bale in the movie The Big Short, which if you haven't seen, there's a lot of good Wall Street movies out there. The Gordon Gekko, Wall Street's all through them, Wolf of Wall Street. But Big Short is actually probably the most educational.
I think so.
That's where Michael Burry gets his fame, is the Christian Bale role of the person who in 2008 really did the math and realized a lot of these mortgage loans may not be as ironclad as they were. So with that kind of preface, Michael Burry's come up in the news again. So
he has.
Who is Michael Burry? We kind of described, but what are his predictions and what are the predictions mean for investors?
Okay. So short answer, shouldn't surprise anybody if you know me. His market predictions aren't worth anything. That's Dave Armstrong's opinion. Okay, that's not to say he's not 15 times smarter than me. He may be 20 times smarter than me. He was right about 2008, but if you saw the movie, you could see that he was wrong for a very, very long time before he was right, which is sort of like a theme with being investing, right? Like you can ultimately be right, but if your timing is off, that just makes predicting so hard. But, what I want to point out is before anyone decides to follow his advice, I just want everyone to consider his past predictions. So I went back, I'm going to call it 8 years, and just kind of went through and collected up all of his predictions. And I'm going to read them in date order, and you read between the lines and come to your own conclusion on this. But here we go. Okay, in January of 2017, he predicted total financial collapse, and he said that World War III was imminent. January of 2017. Okay. Then fast forward to September 2019. He claimed that index funds were like the next collateralized debt obligation, and they were just ready to implode, just like CDOs did back in 2008. Okay. December of 2020. He shorted Tesla, and he started saying that the price was ridiculous and it was destined to crash. Okay. Then you fast forward to January of 2021, where he reiterated that Tesla's valuation would implode soon. But, as we all know, the shares kept essentially doubling over that time. And then in the same month, January of 21. He argued that GameStop's rally would not repeat, only for us to see the GameStop price just explode weeks later. Now, I'm not advocating GameStop, and I'm not saying that people should bid in it. I'm just saying, like, he called that the rally wouldn't repeat, and it did. So then move on a month later into February of 2021, he started to warn that the entire stock market was dancing on a knife's edge, which was his quote, dancing on a knife's edge, and would only to be followed up by claiming that inflation would absolutely destroy Bitcoin, while we saw it hit new highs later that year. Okay, same month, February 2021, he called Robinhood a, quote, dangerous casino. It kept growing users and revenues and was up almost 1,000 times since he made that call in 2021. Then a month later, March of 21, he said Bitcoin was a speculative bubble. And of course, we just kept seeing Bitcoin rally and rally and rally. And then in June of 21, he predicted that, quote, the mother of all crashes was here, and he sold everything. Okay, since then, the market's up 56%. Then in September of 2022, he forecasted that there was going to be a massive stock market failure ahead, only to see the bull market start 2 months later in October of 2022. Then by January of 23, he bet $1.6 billion on a total stock market crash, and he tweeted nothing other than sell. Okay. Later admitting that he was totally wrong to sell. So that's Michael Burry in a nutshell. He has accurately predicted 10 of the exactly 0 blowups that we've seen over the past decade. So Michael Burry comes back in the news because he's shutting his fund down, and people are thinking that's some read between the lines. I'm like, look, the guy has a terrible track record with predictions. Maybe he's going to be right on all of them someday. I certainly hope not. But I do not think that Michael Burry is anything or anyone that a good, solid, disciplined investor needs to be following for market commentary or investment advice. Period. That's Dave Armstrong's opinion.
And I don't want it to come off like we're crapping all over Michael Burry, because again, he got what
facts, right?
Correct.
Yeah.
Well, and that's the problem I see with his investment philosophy. I think at Monument we're very much focused on, to use a baseball analogy, it's the off season. As a Mets fan, my heart is being broken day by day. We're losing all our best players, but Monument's really focused on what I would say a double strategy. Michael Burry is a home run hitter, but when Michael Burry doesn't hit a home run, he strikes out. So that's the kind of strategy that he's really always driving at, and what he does. He takes a lot of strikeouts, but every once in a while, 2008 being probably the best example there could be, he hit a home run. He nailed it. He was right. But Dave, you just laid out all the predictions since then, and the current ones he's making is AI is in a bubble, tech is in a bubble, it's overvalued, it's going to go not to zero, but down significantly. And then recently, all of a sudden, he's now betting, because this is what he does. He takes bets on what's going to happen in an event-driven strategy. He only makes money when this one specific event happens, and it could happen. Mm-hmm. The other one is the launch of Fannie Mae, Freddie Mac, those mortgage insurance companies that got bought or kind of brought in under the government during 2008, becoming private again. So if that happens, he's going to make money.
Right.
But what you're doing is you're putting all your eggs kind of on the event of that happening. And that's, again, the problem with event-driven investing versus where we're data-driven, process-driven, really looking to compound wealth over time. And exactly. In my opinion, consistency is actually such an underrated trait. If you look at how the market has done, if you just got market-like, index-like performance of the S&P 500 by buying the SPY ETF, over the past 5 years, that means you're in the 21st percentile, so almost in the top 20% of all investment fund managers. Mm-hmm. It's very difficult to beat the index, but you got to stick to it over the long term, because if you do, you can see really strong results. Stretching that out, if you look over the past 10 years, the past 15 years, if you got market-like performance, you're kind of in the top 15%-ish of all managers out there. You don't need to swing for home runs like Michael Burry does. What you really need is a consistent approach that you're going to stick to over the long term.
Yeah, if you think back 17 years ago, all hell was breaking loose in the financial markets, right? You had Lehman exploding, and then, as if it couldn't get any worse, you had the Bernie Madoff news hit right about this time 17 years ago. And you look at the market since then. I mean, we're just a little bit shy of the S&P hitting an all-time high. I think right before we started recording, the Dow was already trading in all-time high territory. I mean, if you just went to sleep in the middle of the financial crisis in 2008 and left, and you were like Rumpelstiltskin or whoever it is that fell asleep for 30 years, I can't remember. If you just woke up today, you'd be like, whoa, look at how much money I've made, and just ignored all of that other noise. I think that gets back to what you're saying, that consistency is what leads to success. So it's just leaving things alone and not listening to people like Michael Burry, no matter how smart he is. Like I said, I give him credit. He's probably 20 times smarter than I am. But,
correct.
I just don't
and
think
me too. Like,
but how about you and I together?
Right? Yeah, he's probably still smarter than the combined power. Because again, it's a difficult thing to be. You don't need to be the smartest person in the room, but you need to consistently not be the stupidest.
Right.
Maybe let's put it that way. And I feel like that's a tough thing for investors to accept.
Yeah. Well, we're gonna get into some in a future episode. I'm sure we'll get into some sort of question about such and such investment management firm is predicting XYZ for the S&P. What do we think about it? It's coming. So we'll probably use that to dive into some of the predictions. But look, I just you can read his headlines, but I think if you're taking investment action on your portfolio based on what he's saying, you have a very low probability of achieving success with your portfolio, and you're better off just having okay. I'm making the point over and over again. I think we can move on before everybody starts.
Right. I think that horse is dead.
Right. But let's move on to our second question. How would you describe Bitcoin's 2025 performance? And what is, I'll just say, cryptocurrency versus Bitcoin? What's their place in an investment portfolio?
To bottom line it, it's been a bad year for Bitcoin.
Yeah.
I mean, as of yesterday's close, yesterday midday, Bitcoin moves a lot, but it was negative year to date, slightly. So let's call it zero. But also, too, when you look at cryptocurrencies in general, 2025 has not been their friend, which is pretty weird, honestly, if you think about it. Because really, Bitcoin crypto assets, while a lot of people like to call them digital gold or think about paying for things with Bitcoin, it's really a risk-on, risk-off asset. Usually when it's a risk-on market, meaning riskier financial assets like stocks, speculative stocks are doing well, Bitcoin does. When risk isn't doing well, Bitcoin doesn't. That's not the case this year. The S&P 500 is up 17-ish%, around that mark, and Bitcoin is negative. And that's the first time in about 10 years, I think since 2014, that Bitcoin is going to be negative if we end the year like we are on December 11th here, and stocks are up. So that divergence is more the story to me than about what is the actual performance. It's a volatile asset that is not really keeping up with risk assets, at least this year. Since early October, Bitcoin hit its peak. It's down 26% as of today, but at times was down 33% or more when you go back a few weeks to late November. And it's not just the Bitcoin story. When you look at all the cryptocurrencies, there's now an ETF out there that tracks the 10 the highly traded crypto assets, and that ticker is BITW, is just one to look at. I'm sure there's more than that, but that's the one that I pull up when I want to see how cryptocurrencies are doing. It's the same story. Down significantly since that October mark, but stocks have remained high. So a lot of people love to hear the stories of, I made so much money in Bitcoin years ago. But as it becomes a more highly adopted asset, it's going to be difficult to make those giant sums of money that I think people really drive towards, because it's a volatile asset. You got to stick to it. And while people like to call it digital gold, when the market's pulled back 5% recently, gold was only down 7%. Bitcoin down 30%. You got to be able to absorb that volatility if you're going to hold that kind of asset. It's kind of like predictions. You're going to be right, you're going to be wrong, but either way, if you can't stick to it over the long term, because what's the old saying? You're never wrong, you're just early, but you never know how early. It could be a decade early, it could be 20 years early, it could be 6 months.
Right, like Michael Burry.
You're going to have to go through this. Exactly. He might be right one day,
yeah, sure,
but again,
right.
and buying Bitcoin now when it's down 30 might seem like a no-brainer, quote unquote, because people think it's going to recover. But you don't know how long that's going to take. So if you're not willing to play the long game, volatile assets like Bitcoin, really don't fit in client portfolios or investor portfolios.
Mm-hmm. Yeah, I think, it's Bitcoin like any other commodity. So, and everybody talks about gold, but the very little talked about fact is that silver is up way more than gold this year, and actually platinum's up way more. Everybody's talking about gold. Well, the thing is, like, gold, platinum, silver, Bitcoin, oil, pork bellies, they don't do, it's a thing. And yep. The only way to make money on a thing, and you can ask any cattle farmer out in the world the same question, is more people have to want to buy it than there are units available for the price to go up, and vice versa. It is a 100% supply and demand driven commodity. That's it. It's the only thing that drives the price on Bitcoin or pork bellies or cattle futures. Okay. So because it's just supply and demand, you either need to decide to be in it or out of it, because there's absolutely no way to accurately predict supply and demand. You can think, you can think you have a gut. You can say, like, well, Bitcoin always rebounds from this level. Okay. But just understand that you're taking a decision based on your gut and what you think is going to happen. So Bitcoin, to me, is you either need to buy it and be in it because you think XYZ about it for the future of whatever, and just buy it and leave it alone. But people who are trying to trade it or get in or double their money or whatever, you're exposing yourself to the human dynamics of supply and demand. And I have never seen anybody accurately predict that ever in my life. So end of rant on Bitcoin. Just either own it or don't own it.
Well, and I feel like I get called a hater on cryptocurrencies because the way I phrase them is cryptocurrencies are beanie babies. They're collectibles. Personally, Nate Tonsager, and this is my opinion, at this point, I don't see a lot of money to be made by hoping the price rises and selling it to someone in the future. That is the literal definition in the investment world of what we call the greater fool theory, is you buy something to sell it one day in the future to someone who's going to pay more for it. There's no value. I can't go to, I know there's that person that bought the Domino's pizza, or I forget which chain, years ago, but I can't go to my grocery store and pay for groceries with Bitcoin. I get the appeal of the technology. There is value in having digital currency, but a private currency will never be a thing in my mind. There is too much value for the US government, for other governments to maintain digital currency. So underlying technology, a blockchain, all that is very smart, in my opinion, has a lot of value. But a physical Bitcoin or Ethereum, or I think, Dave, you mentioned on our last recording that we sent out to newsletter subscribers about Fartcoin, like, right, you can name a coin and there's every coin out there. But again, those only have value if people want to buy them in the future. In the same way that if I bought a Pokemon card or a Beanie Baby at a certain price, I only make money if someone else wants to buy it at a higher price.
Right.
There's no value there. So I get it. People are very attracted to it, especially hearing, again, those stories from 10 years ago. I remember in college, my roommate approached me like, hey, should we buy some Bitcoin? It's $250 a coin. We can go half and half and each own half a coin. And I told him he was stupid then. Granted, I was the stupid one way back then. But when you look at it over time, it's evolved into an asset that people desire. But who knows how long that can last?
Right. And you don't know what the odds are of it going up or down. Like, I've got a better idea than Bitcoin. Here it is. Go to Vegas, take all the money that you're going to put on Bitcoin, put it on red or black at the roulette table. You've got a 48.65% chance of winning. At least you know what the percentages of winning are.
Correct. And then close your eyes, because your hands are in God at that point, right?
That's right.
And that's the same thing. So, all right. Yeah. Well, enough about Bitcoin. I think we've kind of, again, beat a similar dead horse, but it's something people are talking about. So, and kind of moving on to our third question, I think is something I keep hearing a lot about. We talked about it in a full episode of Off the Wall earlier this year, but it seems to be coming up again. So, final question that we have for today is, it seems like big investment companies, I've heard of American funds, some of those other big 401k providers that everyone has access to through their company if they have a 401k, are starting to add private credit to target date funds. And just as a quick jargon breakdown, target date funds are designed to select an investment option with the specified retirement year So let's say I select I'm going to retire in 2060. So today I'm going to have a very aggressive allocation given the long time frame. But as it gets closer to that target year, 2060, the portfolio gets more conservative. It's kind of the default option for a lot of people. So if you don't select, most funds will automatically put you in these. But now we're introducing a new asset class, it seems like, in private credit. So I guess the question that we got is, someone asked us, should they be worried about the addition of this new asset class? And is it a good thing, in your opinion, that they're adding private credit to these kind of standard retirement fund options?
Yeah. So let's start out with a little context, because you're right. We did just talk about it. It's come up again in the news because here's what happened. So Capital Group, which is the company behind American Funds, and everybody should probably know what American Funds are because they are a massive provider of mutual funds inside of the 401k plans that people have. So American Funds and Capital Group announced a major partnership. Capital Group, aka American Funds, they announced this major partnership with KKR, right? And what they are one of the largest private equity firms in the world. And their plan is to start blending, like you said, the private credit into target date retirement funds, the ones that sit in millions of 401k accounts, right? Like you said. So, okay, now the marketing pitch that you're going to hear on this is that I'm using my air quotes here, democratizes access to private markets, that everyday investors can finally get into the same diversification that these big pension funds and endowments have enjoyed for decades and decades and decades. Okay, great. That sounds so noble. Thank you very much. You guys, thank you for bringing this democratization to the retail investor in their 401k plan. But you've got to understand why this is really happening, because it's not out of pure nobility. So there's a couple different reasons. There's a few different reasons. One, fees. Okay. So there has been massive fee compression when I say asset management industry, I don't mean Monument Wealth. I mean like the companies that make mutual funds or ETFs. That's what I'm referring to here. The fee compression there has been crushing their margins in these investment companies, asset management companies, for years. And while that's really good for investors, it's not so good for these companies. So they're trying to figure out, okay, how can we generate some more revenue, because fee compression is a real and serious thing. So private markets, right? That's where the money is. So there was this PwC report that came out this year. And according to that, the private markets generate roughly 4 times more profit per dollar managed than the traditional asset managers. I mean, 4 times. So yeah, of course they're looking to see how can we get these private markets available for the retail investor, because traditionally they're not. You have to meet all kinds of accreditor investor rules and things like that. But and that in and of itself doesn't make the product automatically bad. I really want to stress that, okay? But let's be clear-eyed about the motivation here, okay? Because they aren't fighting on behalf of the retail investor. They're fighting for the fees from retail investors. So just be wide-eyed about, the why here. Second thing, you got to be aware of what you are and you are not getting with these private market interval funds, right? These new funds, they're structured right now as interval funds. And that means you can't just sell these things whenever you want to. Okay. Now, I would argue that's actually a really great thing for a 401k investor. I mean, I'm not even eligible to take money out of my 401k, penalty tax, without paying the penalties. So you can really sit on these things for a long time and you can't have access to the money. So by virtue of that, you have a massively long time horizon with your 401k. The younger you are, the longer time you have as a time horizon. Okay. But you can't just sell these things whenever you want to, right? So redemptions happen. But this is important, like if you're withdrawing money out of your 401k too, because redemptions happen quarterly. And they generally have a cap of like 10% of the assets. So if you want out and more than 10% of investors want to get out at the same time, you're going to get prorated liquidity based on how many people are trying to get out at the same time. And so you may only get part of your money back that quarter, not the full amount that you want to get. So, and honestly, like the fees are actually reasonable. Okay. They're like, I'm just going to say like 85 basis points to 90 basis points, or 0.8 of a dollar to 0.9 of a dollar, with performance fees with no performance fees. Okay, so sorry, I want to make that clear. It's a percentage and there's no performance fees. And that's lower than the typical private credit funds, right? So look, I give them credit for that. I do. Okay. But then three, there's the risk. Okay. So private credit valuations don't move around like with the public markets. Think of it like your house. You don't get a daily bid on your house. You can look on Zillow and see what comparables are selling for, but there's no like daily market ticker for your home. You kind of just, it's only worth what it's worth when somebody's ready to buy it and you're ready to sell it. Okay. So that can look like stability inside of an account value. But if you think during the 2022 bond rout, right, public bond funds dropped 13% and many private credit funds barely moved on paper. Okay, that feels really good, but they barely budged on paper, not because they were immune to rising rates, but because they just don't mark to market in real time. Go back to my house analogy there. So the losses were there. They just weren't visible because they weren't being marked to market. So for example, just last month, a company called Blue Owl withdrew a proposal to merge a retail private credit fund with a larger institutional fund after the news sent their stock down 10%. So retail investors in that fund faced a potential 20% loss and a redemption freeze and everything else. Like, look, that's not ancient history. That was just a month ago in November. So there are risks in these things. So I think as long as people understand why these companies are doing this, investors are aware of what they're getting and they're not getting, especially as it relates to redemptions and liquidity, and they understand the risk. I don't think that they're evil or bad, but I just don't think people should be buying them because, oh, wow, I can do the same thing as an institutional investor or a foundation.
So let me put it bluntly. I don't think this is a good idea to open up private credit to the average investor for all the reasons you just laid out, Dave. They can be expensive, they can be illiquid, and they're so freaking complex. Mm-hmm. You know, we do have some clients where private credit makes sense, but that is, I would say, a case-by-case basis and not opened up to everyone. When you put it in 401ks, you're opening it up to everyone. But not everyone needs these kind of investments. You can benefit from them in the right scenario, but most people, what they're doing is they're taking on extra risk because private credit funds post what I'm going to call a juicy yield because they're lending in illiquid markets to smaller, riskier companies. So you might see private credit funds that yield 10% or, high single digits when your bond fund in the public markets is yielding 3%. Mm-hmm. A lot of people get suckered into that, but they don't, I think, realize that higher yield comes with higher risk. There is no way around that. If you're going to be generating more yield, that's because you need more yield to lend to riskier companies. I'm not going to lend to a risky company at the same rate that I'm going to lend to a quality company. Do people need more risk? I don't know if they really do because each client's different. And that's the thing, is most people are going to see a higher risk portfolio with the potential for higher returns. Again, but you got to understand what you're investing in and what that means in adding it. And when they're being jammed into these target date funds, because it seems like investment companies want to, again, it's a very fee driven. It's not as noble as it might seem in the media. There are benefits, there are costs, but really what you're doing is you're making everyone an investor in it when they don't necessarily maybe need it. So invest intentionally. We always talk about this. Like when you're investing your money, do it because you want to and because you understand everything, not because someone jammed something in a portfolio because they thought it was a good idea. So it's a delicate balance. It really is. Again, I don't want to come off saying like everything is bad, nothing is good in this space, because we do see clients with investors who benefit from these, but it's got to be the right situation.
Yeah, exactly. Well said.
I think this is kind of the perfect. I know we said we kind of had a bonus question. I know we only teased 3 topics at the beginning, but we actually had a comment come in through our YouTube channel that I felt like was pretty tied into the private credit. In this case, talking about private equities.
Yeah, let's jump into that. Even though it's like the 4th thing, let's we're only at about 90 minutes at this point of the podcast length. So I'm sure we haven't lost anybody. So let's just jump into that. Yeah, but let's
I mean, we got to give the people what you want. If you're going to take the time to leave a comment, we're here for you.
Exactly. And it is tied, so let's jump on it. It's good. It's a good question.
Yeah. The question we got is, Fed cut interest rates yesterday. As interest rates continue to come down, hopefully, I'm going to put that word in quotes, how do you view private credit, and why are the benefits of declining interest rates maybe higher for private equities versus public equities? So as rates come down, why do private equities seem to be maybe the bigger beneficiary than public equities? And I think if I can just dive right in, I know we talked a lot about private credit. Now we're focusing on private equity. So companies, and maybe not necessarily in the debt markets, but in the equity space. If you ask me, first off, rates are probably going to be lower a year from now than they are today. Will they be significantly lower? I don't want to make that prediction. We talked a lot about predictions, but I am okay saying rates are going to continue to come down based on the data we're seeing. Well, interest rates are the core of all financial math. Any financial math you do about future earnings, future cash flows, debt rates that you're going to be lending at, all of that comes into what is called the risk-free rate. And what that is there's nothing that is risk-free in investments, but really looking at U.S. government short-term debt interest rates as the most predictable and most reliable, that risk-free rate. And if that rate comes down, what that really means is there's less of a hurdle to clear. If I can go buy a T-bill at 3%, every investment I'm going to buy that's riskier than that needs to earn more than 3%. If that rate comes down to 2%, well, now I need maybe less of a return in riskier assets. And private equity is a pretty risky asset, if you ask me. You're usually lending to smaller companies that are illiquid. So when that risk-free rate comes down, private equities can look more attractive pretty quickly.
Right.
And again, it's all about how do you balance that math, because that's all really financial investing is when you're looking at fundamentals, which a lot of people do. Monument, we do a little bit of, I would say, both, but a lot of people are just pure fundamental investors where they're doing the math. And as interest rates come down, the amount of return that needs to be generated from risky assets also comes down. And the riskier the asset, it seems like kind of the faster that rate can come down. So that's why private equities could be a beneficiary. It also allows them, I would say, to borrow. Talking a little bit about private credit is when your risk-free rate comes down, that also means you can borrow at lower rates. They can borrow to do buyouts. I think a big thing that came up in the news recently was Netflix wanting to buy Warner Brothers, but taking on a lot of debt to do so. Well, if rates come down, they can hopefully borrow at a lower rate, meaning it's easier for those private companies to get acquired or purchased by public companies. So, I mean, to really just make it simple, as interest rates come down, the financial math gets easier for so many things, which is why you see risk assets appreciate.
That was a very simple explanation, a great answer. So it's exactly like you said it. So, like your house probably goes up in value when interest rates come down because people are able to get loans at a cheaper interest rate and buy houses. So it pushes up the demand and makes it easier to sell. Okay, it's not the perfect analogy, but that's my tag on there. So,
and I think that's the thing is, again, it changes the math for everyone, which is why everyone's been clamoring for lower rates for so long. So we'll see. 2026, new year, anything can happen. So we'll just keep on pins and needles and watch the data.
Exactly. Well, if you made it this far into the end of this episode, thanks for listening. As a reminder though, if you have a question or you want your question answered in our next Ask Monument Anything segment, just submit it to us anytime. So if you're a client, you have our email address, just send it to us. But if you're a casual listener just coming across this, we have a specific email address set up. It's offthewall@monumentwm.com. So it's all one, like offthewall@monumentwm.com. Shoot us a question there.
Yeah, or just be like the YouTube comment that became our bonus question today, right? Like leave us a comment. We're always kind of watching them to see what people want to know more about. And I know we talk a lot about investments on Off the Wall here, but I always like to let everyone who's listening know that if you enjoyed our show here today, make sure you're also checking out Monument's sister podcast, which is Between Sips, which really focuses on financial planning topics, estate, charitable giving, a little bit different kind of content than what we focus here with investing on Off the Wall, but still extremely valuable, especially because, a lot of wealth breeds the chance of options. So the more wealth you have, the more options you have. And really what we want to focus on is helping clients understand the options that their wealth can give them. So outside of investing, there's a whole lot you can do on the financial planning side. And that's where Between Sips adds a lot of value. So make sure you're subscribing to both, because wealth without meaning will never feel like true wealth. You always feel like you're looking for something. So really setting up that meaning matters so much. And by subscribing to both, you'll get all the episodes as soon as they're released right at the top of the feed. You never have to look for either one.
Yeah. Okay, so with that, we'll see everybody on our next episode of Off the Wall. Everybody have a great holiday season, a great new year, and goodbye. We will see you in 2026.
The previous presentation by Monument Capital Management LLC was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Different types of investments involve varying degrees of risk. It should not be assumed that the future performance of any specific investment or investment strategy or any non-investment related planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Monument's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Monument is engaged or continues to be engaged to provide investment advice services. Monument is neither a law firm nor an accounting firm. No portion of its services should be construed as legal or accounting advice. No portion of the video content will be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Monument is engaged or continues to be engaged to provide investment advisory services. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request at www.monumentwealthmanagement.com.